Chapter 9. External Trade. External trade is the process of import, coming in, and exports, going out, of goods and services, visible and invisibles, in and out of the country. The need for trade arises in the light of the fact that no country is self-sufficient in terms of resources. They are endowed with different resources and different levels of development and income. Terms of trade is an important concept which refers to the rate at which a country exports against its imports. When the export price of a country is greater than its import price, terms of trade is said to be favorable for that country. Conversely, when the import price of a country is greater than its export price, terms of trade is said to be unfavorable for that country. Need of external trade. As stated above, no country is self-sufficient in everything. Additionally, needs of every country is changing continuously. In short, there is a relative deficit in each county, which could either be resources or people or knowledge or technology or markets or even goods and services, differing in terms of their range and superiority. To cover this relative deficit and for optimum utilization of available resource, each country have external trade with other countries. Other features of external trade is given below in summarized form. Benefits from international trade are in the form of increase in investment and subsequent rise in production, cheaper goods and services leading to increase in consumption, enhancement of consumer welfare and many other related advantages, including socio-political. External trade promotes economic development through optimum use and allocation of resources, technological progress and healthy competition. But over-dependence on external trade can obstruct the way to build a self-reliant economy. It can result in dependence and loss of sovereignty to the tune of exploitative colonial and imperial rule. Further, it may not always be possible to have comparative advantage owing to national priorities and limited resources. External trade reforms. Indian economy in pre-LPG era was essentially an inward-looking economy with strong insulation from rest of the world. In 1973, Foreign Exchange Regulation Act, FARA, was enacted to restrict and regulate foreign exchange transactions. Under FARA, a large number of transactions were placed in (100) General Studies, Mains, paper. Negative lists, and the ones which were allowed were permitted only after seeking approval of appropriate authority. All foreign-owned companies were designated as FARA companies. FARA also vested powers to try out criminal cases of violation in foreign exchange regulations. Moving towards greater openness after economic reforms of 1991, FARA was repealed as a part of major trade sector reforms. A new Foreign Exchange Management Act, FEMA, was enacted in 1999, which made the way for management of foreign exchange regulations rather than their regulations. FEMA was more liberal in nature as it sought to permit rather than to prevent. It lowered the negative list. It also eased restrictions on cross-border capital flows, especially foreign investment, providing a clear sign of lowering insulation. FEMA essentially covers broad areas of foreign exchange management, including borrowings by corporate sector, rupee convertibility, and setting up of Enforcement Directorate, ED, for trying out offenses in foreign exchange. External trade liberalization. Quantitative restrictions, ORs, on imports of intermediates and capital goods were removed immediately, and by the turn of the century, QRS on imports of consumer goods were also removed. Our peak tariff rate has come down from 150% in early 90s to 12% now for non-agriculture products. Moving in line with greater facilitation of trade, the then EXIM policies had lowered peak-level customs duty, paving the way for greater imports. India's free trade policy. Till late 1990s, India mainly stressed on WTO route for trade liberalization. However, the success of free trade agreements, FTAs, elsewhere prompted a change in government policy, and FTAs and CEPA. Comprehensive Economic Partnership Agreements began to be negotiated. The first FTAs were the result of politico-strategic considerations. Examples are India-Bhutan Treaty, 1949, India-Nepal Treaty, 1950, and Bangkok Agreement, 1975. Next phase began when FTAs began to be signed increasingly for their economic logic. A distinction from the earlier phase was that now broader group of stakeholders including academia and businessmen were involved in the negotiations. Examples are SAPTA, 1993, India-Sri Lanka FTA, 1998, India-Thailand FTA, 2003, BIMSTEC, 2004, India-Mercosur PTA, 2004, and India-Singapore CEPA, 2005. Foreign Trade Policy, 2015 to 20. Trade policy is formulated and implemented by the Ministry of Commerce and Industry, along with other concerned ministries. India considered trade policy as an instrument to attain IL's overall economic policy objectives of growth, industrial development, and self-sufficiency. Trade policy is also used to attain short-term goals like containing inflation. Trade policy is announced in every 5 years. The policy is also known as EXIM policy. The Foreign Trade Policy, FTP, 2015 to 20 was unveiled by the Ministry of Commerce and Industry on the 1st of April 2015. Highlights of FTP 2015 to 20. It aims to inspire confidence in India's capabilities amongst potential partners abroad, the Indian business community and citizens at large. It aims to reach out for a vast local and global audience via social media and constantly keep them updated about opportunities, reforms, etc. The policy aims to increase India's exports to $900 billion by 2019-20, from $466 billion in 2013-14. It also targets to raise India's share in world exports from 2% to 3.5%. FTP 2015 to 20 introduces two new schemes, namely, Merchandise Exports from India Scheme, MEIS, for export of specified goods to specified markets, and Services Exports from India Scheme, SEIS, for increasing exports of notified services. Benefits of SFIS and MEIS have been extended to SEZ. Black circle measures have been adopted to nudge procurement of capital goods from indigenous manufacturers under the EPCG, Export Promotion of Capital Goods, scheme by reducing specific export obligation to 75% of the normal export obligation. This will promote the domestic capital goods manufacturing industry. Black circle trade facilitation and enhancing the ease of doing business are the other major focus areas in this new FTP. One of the major objectives of new FIP is to move towards paperless working in 24/7 environment. External trade. 101. Other measures incorporated with FIP 2015-20. Industrial products to be supported in major markets at rates ranging from 2% to 3%. Branding campaigns plan to promote exports in sectors where India has traditional strength. Measures to facilitate and encourage export of defense goods. Manufacturers who are also status holders will be enabled to self-certify their manufactured goods as originating from India. Online procedure to upload digitally signed documents by chartered accountant, company secretary, cost accountant to be developed. Benefits available to handloom products, books, leather footwear, toys and customized fashion garments. FTP 2015 has the potential of spurring India's export, but the outcomes will be divided by the way it is to be implemented along with other macroeconomic global factors. Balance of payments. The balance of payment, BOP, of a country is a systematic account of all import and export transactions between a country and the rest of the world, undertaken during a specific period of time. BOP is the difference between all receipts from foreign countries and all payments to foreign countries. If the receipts exceed payments, then a country is said to have favorable BOP. And vice versa, the payments received from foreign countries enter as credit and payments made to other rupee-denominated debt is preferred over countries as debit. RBI is responsible for compilation and dissemination ROP data. Terms related to balance of payments. The terms related to balance of payment are as follows. Balance of trade, BOT. It is the balance of merchandise goods as it records all transactions on account of export and import of goods. The BOT would be in surplus if the exports are more than imports. Conversely, it would imply a deficit if import is more than export. India, being a developing economy, has had a structural trade deficit since its imports outperform the exports. Balance of invisible, BOL. It records import and export of services, inward and outward tourism, inward and outward remittances, net expenses for education and medical treatment, etc. This could either be positive or negative depending upon which is more. Current account balance. The current account includes export of services, interest, profits, dividends and unilateral receipts from abroad and the import of services, profits, interest, dividends and unilateral payments abroad. There can be either surplus or deficit in current account called current account surplus, CAS, or current account deficit, CAD, respectively. Current account balance is very significant. It shows a country's earning and payments in foreign exchange. Capital account of balance. Under capital account, capital inflows can be classified by instrument, debt or equity, and maturity, short or long term. The main components of capital account include foreign investment, loans and banking capital. The capital account records all international purchase and sales of assets such as money, stocks, bonds, etc. In India, foreign direct investment, FDI, is preferred over portfolio flows as the FDI flows tend to be more stable than portfolio and other forms of capital flows. Foreign currency debt and medium and long-term debt is preferred over short-term. Factors responsible for capital flows are push and pull factors. These are push factors are external to an economy and inter alia include parameters like low interest rates, abundant liquidity, slow growth or lack of investment opportunities in advanced economies. One, pull factors like robust economic performance and improved investment climate as a result of economic reforms in emerging economies or internal to an economy.
చూడు ఇదేట వెనక్కి బరుకుతానమాట లేసి వచ్చాయి బొక్కల నుంచి
ఫస్ట్ టైం వింటుండ
గుండు మరి గడు ఎప్పుడు ఎట చేస్తాడు చెప్పు నీ గుండు ఈ చూడు ఈ నుంచి మొదలుపెట్టి ఇది ఇట కట్ చేస్తాడు ఇది ఇట కట్ చేస్తాడు
ఏం కదా రంజిత
General Studies, Mains, Paper I Flow's capital account convertibility implies the freedom to convert domestic financial assets into this. 102. Composition of balance of payments account. Payment debit, import of goods. Receipt, credit. Export of goods. Export of services. Interest, profit in. Dividends received. Import of services. Unilateral receipts in terms of inward remittances, education and medical treatment. Interest, profit in. Dividends pack. Unilateral payments in terms of outward remittances, Caucasian and Moschel treatment. Foreign investments. Investments abroad. A. Deposits and borrowings, external assistance in. Grants. Lending. Medium and long term. Overseas financial assets at market determined rates. It can also imply conversion of overseas financial assets into domestic financial assets. Broadly, it would mean freedom for firms and residents to freely buy into overseas assets such as equity, bonds, property and acquire ownership of overseas firms, besides, free repatriation of proceeds by foreign investors. The primary objective behind the adoption of CAC in India was to make the movement of capital and the capital market independent and open. This would exert less pressure on the Indian financial market. The proposal for the introduction of full CAC was present in the recommendations suggested by the Tarapur Committee approved by the Reserve Bank of India. Tarapur Committee, 1997. The Tarapur Committee appointed by the Reserve Bank of India, RBI, was meant for recommending methods of converting the Indian rupee completely. The report submitted by this committee in the year 1997 proposed a 3-year time period for total conversion of rupee. However, according to the committee, this was possible only when the following few conditions are satisfied. T. Errors and omissions. Errors and omissions. Convertibility. Convertibility allows the individuals to freely exchange their domestic currency into foreign currency or vice versa. It means that there is freedom of choice and that choice is governed by market forces rather than government regulation. Importance of convertibility. The importance of convertibility are as follows. Absence of convertibility is seen as a hindrance to smooth inflows and outflows, resulting in avoidable delays in conversion, besides increasing cost of conversion. It is also believed as a way to attract foreign investment. The average rate of inflation should vary between 3% to 5% during the debt serving time. Decreasing the gross fiscal deficit to the GDP ratio by 3.5% in 1999-2000. Cash reserve ratio, CRR, to be reduced to 3%. Recommendations of the second Tarapur. It reflects greater transparency in foreign exchange transaction in domestic economy. It enhances the levels of the home currency and global acceptability. It provides greater levels of efficiency, provides depth to financial sector and Makes currency globally competitive. Committee. RBI appointed the Second Terraport Committee to set out the framework for fuller capital account convertibility. The committee suggested 3 phases of adopting the full convertibility of rupee in capital account: Phase -1, 2006-07, Phase 2, 2007-09, and Phase 3, 2011. Types of convertibility. There are 2 types of convertibility: capital account convertibility and current account convertibility. Following were some important recommendations of this committee are as follow. 1. Capital account convertibility, CAC. In a country's balance of payments, the capital account features transactions that lead to changes in the overseas financial assets and liabilities. These include investments abroad and inward capital. The ceiling for external commercial borrowings, ECB, should be raised for automatic approval. NRI should be allowed to invest in capital markets. NRI deposits should be given tax benefits. Improvement of the banking regulations. External trade. 103. Foreign institutional investors should be prohibited from investing fresh money raised to participatory notes. The committee recommended that the present tax benefit for the special deposit schemes for NRIs should be allowed to open. FCNR-B should be reviewed by the government. Non-residents, other than NRIs, should be allowed to open FCNR-B and NRERA accounts without tax benefits, subject to Know Your Customer, KYC, and Financial Action Task Force, FATF, norms. At present, the rupee is fully convertible of the current account, but only partially convertible on the capital account. A transparent fiscal. The risk of currency crisis. Domestic financial institutions, in particular banks, need to be strong and resilient. The quality and proactive nature of market regulation is also critical to the success of efficient functioning of financial markets during times of currency crisis. 2. Current account convertibility. Current account convertibility allows free inflows and outflows for all purposes other than for capital purposes such as investments and loans. In other words, it allows residents to make and receive trade-related payments, receives dollars, or any other foreign currency, for export of goods and services, and to pay dollars for import of goods and services, make sundry remittances, access foreign currency for travel, studies abroad, medical treatment, gifts, etc. Rupee is fully convertible as far as current account transactions are concerned, e.g. import, export, interest, dividends. Exchange market. A foreign exchange market refers to buying foreign currencies with domestic currencies and selling foreign currencies for domestic currencies. Thus, it is a market in which the claims to foreign monopolies are bought and sold for domestic currency. Dollars. Foreign exchange refers to foreign currencies possessed by a country for making payments to other countries. It may be defined as exchange of money or credit in one country for money or credit in another. Foreign exchange is also referred to as forex market. Participants are importers, exporters, tourists and investors, traders and speculators, commercial banks, brokers and central banks. Foreign bill of exchange, telegraphic transfer, bank draft, letter of credit, etc. are the important foreign exchange instruments used in foreign exchange market to carry out its functions. The foreign exchange market performs the following functions. The basic function of the foreign exchange market is to facilitate the conversion of one currency into another payment between exporters and importers. The foreign exchange market also provides credit to both national and international institutions to promote foreign trade. Consolidation is necessary and desirable to reduce. A third function of foreign exchange market is to hedge foreign exchange risks. Hedging can be done either by means of a spot exchange market or a forward exchange market involving forward contact. Exchange rate determination transactions in exchange market are carried out at exchange rates. In foreign exchange market, two types of exchange rate operations take place. They are spot exchange rate and forward exchange rate. These are as follows. Spot exchange rate. When foreign exchange is bought and sold for immediate delivery, it is called spot exchange. The basic principle of spot exchange rate is that it can be analyzed like any other price with the help of demand and supply forces. Although the spot exchange rate is for delivery on the best value date, the standard settlement date for most spot transactions is 2 business days after the transaction date. The exchange rate of dollar is determined by intersection of demand for and supply of dollars in foreign exchange. The demand for dollar is derived from countries' demand for imports, which are paid in dollars, and supply is derived from countries' exports, which are sold in forward exchange rate. Here foreign exchange is bought or sold for future delivery, i.e. for the period of 30, 60 or 90 days. There are transactions for 180 and 360 days also. Thus, forward market deals in contract for future delivery. (104) General Studies, Mains, Paper 3. Depreciation of Indian Rupee. The price for such transactions is fixed at the time of contract, which is called a forward rate. Forward exchange rate differs from spot exchange rate, as the former may either be at a premium or discount. If the forward rate is above the present spot rate, the foreign exchange rate is said to be at a premium. Exchange rate policy. Foreign exchange rate in the market may directly or indirectly be influenced by the action of government in market. Like devaluation. When foreign exchange problem is faced by the country, the government tries to reduce imports and increase exports. This is done through devaluation of domestic currency. Under devaluation, the government makes a deliberate effort to reduce the value of currency of home country. If devaluation is carried out, then the exports will become cheaper and imports costlier. This in turn will help to reduce imports and increase exports. Depreciation. Depreciation, like devaluation, lowers the value of domestic currency or increases the value of foreign currency. Depreciation of a country's currency takes place in free or competitive foreign exchange market due to market forces. Depreciation and devaluation have the same effect on exchange rate. If there is high demand for foreign currency than its supply, it will depreciate the home currency. However, in several countries, the system of managed flexibility is followed. If there is more demand for foreign exchange, the central bank will release the foreign currency in the market from its reserves so as to reduce the appreciation of foreign currency. In recent times, number of factors has led to steep depreciation of the rupee vis-a-vis dollar. India has had chronic trade deficit leading to high CAD and more demand for dollar than supply. Further, recent Eurozone crisis has adversely impacted Indian exports. It has also ballooned due to high crude oil prices and surge in gold imports. Once the rupee begins to slide, it further widens the CAD, leading to further downslide of rupee. Similarly, high inflation makes raw material services costly for the export-making export. Product less competitive vis-a-vis Chinese export. Recent announcement of U.S. Federal Reserve taperings in revival of U.S. economy has further pushed the outflows. U.S. Treasury bonds are considered the safest investment. During the peak of Greece crisis, the big investors started pulling out money from Europe and investing it in U.S. Treasury bonds, which implied increased demand of dollar. For past few years, Indian government's inefficiency regarding environmental project clearances, land acquisition, FDI in retail, pension, insurance, etc., has led to foreign investors losing faith in Indian economy, resulting in slowdown in FLL inflows. Currency war. Currency war, also known as competitive devaluation, is a condition in international affairs where countries compete against each other to achieve a relatively low exchange rate for their own currency. As the price to buy a particular currency falls, so does the real price of exports from the country. Imports become more expensive. So domestic industry and thus employment receives a boost in demand from both domestic and foreign markets.
బస్ కండక్టర్ జాబ్ కొట్టి చాలు ఫస్ట్
Types of currency.